Hey everyone, welcome to the KE Report and a daily editorial talking more about the economic data that we have seen out of the US just this last week. We are chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which I'll post a link to in the show notes. Now, Marc, we got a lot of data out of the US this last week, inflation data, jobs data, and a lot of it came in pretty decent, if not good, maybe better than expected overall. Argument being that, well, data is always backward looking. And because of what happened at the later part of the first quarter of last year, maybe we saw some pull forward in terms of purchases, in terms of business action, and future data could be weaker. Again, that's all a big question mark and also ties into still that broad negativity that a lot of people have about what's happening in the US, especially around tariffs. But Marc, break down what you saw in the data and if you are in that same camp that says we just had a pull forward, watch out for Q2 and even worse, Q3.
Yeah, Corey, I'm in that camp that says that Q1 GDP that contracted by 0.3% annualized pace, but basically the stagnant economy is probably overstates the weakness of the U.S. economy. Like you said, there does seem to be a lot of pulling forward, what I sort of call eating our corn seed, bringing forward things that we might have done, economic activity that might have been Q2 or Q3 type event. So we saw a huge surge in U.S. imports. It looked like about half those imports went into inventory, and that might really understate the case. And when you see the big jump in business investment, which Steve Moran, the advisor to the president, sort of praised, remember that in GDP math, inventory accumulation counts as business investment. So that business investment number, just as like the import number was exaggerated, and consumption, which slowed from Q4, might also have been exaggerated to the upside. However, to your point, the survey data continues to be weak. This is what Powell and others call soft data, and it's been weak. And we're going to probably have more weak survey data in the coming days. But the real sector data so far has been holding up fairly well. For example, if you were to exclude what's that sort of these inventories, trade, government spending, and look at this measure called final sales to domestic parties, which is can be considered to the underlying signal of the domestic economy, private economy, it was up more than 1.5%. So that this points to some underlying strength, and the jobs data before the weekend was stronger than expected. It's not, I wouldn't say it's a spectacular jobs number. I would just say it's a solid jobs number, which still shows the real sector hard data holding up a bit better than the survey data. And until that changes, I think we've got to expect the Federal Reserve to still be cautious and patient, waiting for this uncertainty to be lifted.
Well, Marc, if you think about it, if you take the month of April out of the equation and just look at the whole year and look at the market's reaction, look at the economic reaction, look at the reaction from consumers and from companies, April was a little wild. Some of this started in March because it was looking ahead to the tariffs happening. So those Q1 numbers include that March pull forward. But we started hearing just a couple of weeks ago that the recession was on in full force. There was going to be possibly a deflation. This was a long-term shift away from the United States, a long-term shift away from sanity. And just a couple weeks later, it's almost like it hasn't happened. People are tired of it. The markets have rebounded. The economic data isn't matching the survey expectations. So are we still going to have a recession? Is that still imminent? Is the Great Depression Part 2 still right around the corner, or has everybody called that off now?
I don't think that's what's happening, though. We did have one quarter now of negative growth. And you look at what the Atlanta Fed says, tracking a 1.1% annualized pace for Q2. So I think that what's happened is that I'm still in this camp. I know it's going to sound kind of strange, Chad, given like the strength of the jobs data and this depiction you just painted for us. But I think that there's a shadow crossing America around now. And we're only in the early stages of it, like a slow moving train wreck, if you will. And this is the drying up of the shipments from China. Think about what's happening. You know, these container ships take a while to get from China to the US, to the West Coast. And we already see pictures of the ports from Seattle, LA, Southern California. Ports are slowing down. And this is going to affect the Midwest with a couple of weeks lag and another week or so lag to get to the East Coast. So I think that it's possible that we see through all this, that this is just noise. But I think there's something fundamental going on when the world's two largest economies have an embargo against each other. And that's what these high tariffs mean. It doesn't make sense really to trade very much with each other. And so I think that this is going to affect, not, I mean, I just think that this is part of this, like I say, a shadow. You've got the ports, then you got the trucks, you got the logistic companies. And then this doesn't even think about yet, incorporate into it, the layoffs from the government and the cooling off of immigration and the consumer boycott in Europe and Canada against US brands and the drying up the tourism of the forward booking. So I hate to be pessimistic. It's just early May. We're a little bit more than 100 days into President Trump's second term. But I think that we could be on this edge of a serious economic downturn, even if it's in slow motion. And I think that it's important. I mean, the borrowing of the future demand, paying it forward, this kind of thing. I'm still very concerned whether, but this is the problem. What exactly does it mean to have a recession? Some people think that some sectors in the U.S. are already in recession, but the overall economy did contract in Q1, and it looks like it's growing very slowly in Q2. And this is even before the full impact of these tariffs. And remember, those reciprocal tariffs and negotiations, this is going to continue for several more months. We're looking at July, August for these things to be coming back. And so I don't think we're out of the woods yet.
Yeah, to your point about travel really declining, it is week after week. Even this morning, Marc, I was going through kind of my Google News feed and one more article. I see it every week about Air Canada or WestJet canceling flights to U.S. destinations and shifting their routes due to simply lower demand. A lot of the friends I talk to as well are just saying, yeah, we're probably not going to go to the U.S. And that is something that will last a while. People won't shift right away. I do take the stance on goods, though. If trade agreements open up again, consumers do tend to buy the lower priced items, and sometimes they just don't really turn that item over to see where it was made. But again, most of those low price items, pretty much all of them, come from China. So this seems like China could be a winner out of the whole thing. What are you seeing in the currency markets? Because look, markets have rebounded. Even the dollar has rebounded, but quite frankly, the dollar right around the 100 level on the dollar index, that's kind of low over the last couple of years. The dollar just last month broke down to levels that weren't seen since early 2022. That 100 level, while it is just a round number, has historically shown to be either pretty strong resistance or pretty strong support. Is the dollar in trouble here in your eyes?
Corey, the dollar has been falling. The dollar index itself peaked about a week before President Trump's inauguration. We've been sliding since. And the interesting thing that happened in this past week is that the dollar index moved above that 100 level. And it's really 120 level is key for this chart pattern that looks to be unfolding. When I look at the chart of the dollar index, I see a head and shoulders bottom with a neckline at about 100.20. If we could close above there, it would project to something like 102.40 or so. The problem with this pattern, though, is that the pattern was really confirmed on Thursday, but there was no follow through on Friday. And so one has to decide now, like, is this a failed bottoming pattern, which would be negative for the dollar index? Or is this just these technical things is more of an art that some kind of bottom is being formed? I'm in that latter camp. I thought it could have been a head and shoulders bottom. I still haven't given that up. But the price action ahead of the weekend is a bit disappointing, especially given the strength of the U.S. jobs data and the backing up of interest rates. The U.S. two-year yield is up 12.5 basis points today, and the 10-year is up almost 10 basis points. But the dollar didn't get that much traction from it. And so it's disappointing, but I haven't given it up. There's three reasons why. One is that the real sector data in general is coming in better than expected. Maybe that's to Shad's point, that the market might have once again leaned a little bit ahead of its skis in looking for a quick downturn. Secondly, with this stronger than expected real sector data, the market never had a high chance for a cut from the Federal Reserve in the coming week, but it's also downgraded dramatically the chances for a June cut. So the market pushes off further Fed rate easing into the second half of this year. That's causing this backing up of interest rates. And the third factor, why I'm still thinking that we get this upside correction for the dollar, is that the momentum indicators were oversold. I mean, if you think about it, we sold off from middle of January through really the middle or so, maybe even late April. And so the momentum indicators were overstretched, oversold for the dollar, and they're just turning up. And so when I combine these things, the real basis for me, a lot of time in short to medium term currency movement are relative interest rates and relative central bank policy. And I think the jobs data affects that. And so that's why I'm within the context, of course, of these momentum indicators is why I'm looking for the dollar to continue to work higher in the next week or two.
Yeah, Mark, I'm glad you brought up interest rates in conjunction with the currencies because that's exactly where I wanted to go as far as we've seen an uptick, as you noted, in the 2-year, the 10-year. Rates are going higher, so bonds are selling down. But you're also not hearing a whole lot of noise in the markets or people talking about the Fed. As we mentioned, there's a Fed meeting next week, but it was for a while that people had a Fed obsession. Everything that came out for economic data was put through the lens of, well, what will the Fed do in response to that? Coming into this year, there were still expectations of a lot of rate cuts. If we're having better jobs numbers, if we're having better inflation data than we expected, those are the two mandates of the Fed. Does that push back their need to cut rates? How does that affect interest rates and the dollar? But then also, how does that affect the markets?
Yeah, so Shad, the markets before the jobs data, the market was leaning towards 4 rate cuts this year. After the jobs data, the markets pulled back to a solid 3 rate cuts this year. And that still is more aggressive than the Federal Reserve thought in March when it had, and the median was for 2 rate cuts. So the markets still seem to be a bit more dovish than the Federal Reserve. And possibly, I think, because the markets can think about preemptively, while the Federal Reserve really can't act preemptively, especially, some pressure from the White House to cut interest rates. Treasury Secretary Besson said the low 2-year yield meant that the markets were pushing the Fed, thought the Fed ought to be cutting interest rates. I think it's more complicated than that. I think that the market does anticipate that the economy is going to slow down and through the jobs market rather than through lower inflation to get the Federal Reserve to resume its rate cuts. So I think it's a bit early to tell, but I'd say that rate cut still is fully priced into July. So the market, I think, has effectively done removed 1 rate cut and pushed a move to begin in July. But if it pushes in July, that means you get 3 rate cuts in the second half of the year, which right now seems a bit aggressive.
So, Mark, looking globally too, what do you take away from any sort of money flows that you're seeing where the dollar has bounced, the market has bounced, but international markets have also bounced? Where is money going? Or is this still kind of a mixed and muddy environment that we're seeing?
Yeah, isn't that amazing? What happens is that maybe Shad's point, the stock market sells off. Everybody's screaming, the U.S. is a third world country, and we finished April, having recouped nearly everything that was lost in the month. So finishing the month practically flat. Not only the S&P 500, but the Nasdaq and U.S. interest rates pulled back. The 10-year peaked around 460, and we finished the month below 430. The dollar, however, hasn't really recouped. The dollar is still more or less in its trough. And so to me, that was the missing piece that's going to play catch up. But we'll see. I think that Europe is still an interesting place. I think that people have been underweight. I think that this rally in the U.S. stocks are people a lot of it who got out, who needed to get back in. So I'm still cautious about the world economic outlook. I think that that's partly what oil prices were telling us, not just that OPEC and Saudis were going to continue to press ahead with their increase in output, and that the U.S. was pushing against Iranian oil again and threatening sanctions on any country, which really means China, which buys about 90% of Iranian's oil, as another flashpoint. But I sort of see the low price of oil to also be reflecting anticipation of weaker demand.
Interesting. Well, Mark, we'll wrap it up here. Very interesting week as we're going through earnings season. We're also seeing this rebound in markets really globally as this sense of calm maybe has come over the markets, but it's not overly calm. Everyone seems very worried about still what's coming in the future, but the markets are saying, hey, this is a buying opportunity. Let's see how long we can take it higher until we get another shock from it seems like geopolitics, mostly politics out of the US. Who knows when that's going to happen? But right now, maybe as we move more into summer, we do get a little slowing down of all this fear, but also maybe not. So, always interesting hearing what you're seeing, especially on the currency side of things, Marc. Again, Marc Chandler is the managing partner at Bannockburn Global Forex, also editor of the Mark II Market website. Marc, great chatting with you. Thank you very much for your time this week.
Thanks, guys. Good luck to everybody.